So very good morning and welcome to this course on the entrepreneurial manager. So here we're going to see a very important topic from Unit 4, which is called the financing of the enterprise. And here the subtopic is going to be venture capital. So let us quickly get into the understanding of this topics. So this is the overall what I'm going to talk today. Completely whatever the slides we are going to discuss today. These are the overall slides which we're going to discuss now. So, introduction to let us understand what you mean by venture capital. Venture capital is basically, first of all, it's a financing. It's a financing. Okay, and what type of financing is it? It's a equity-based financing. So there are debt financing, there are hybrid financing, and equity financing. So this comes under the equity financing. Equity financing, and where it is done for what type of enterprises? It is done for enterprises who are in the early stage, and also the enterprises which are in high growth. So this is actually venture capital. And who is providing this venture capital is provided by venture capital firms and then angel investors. And then corporate venture capitalists are also there and venture funds. So this is venture capital. And here the focus is on not any particular startup. We talked about high growth startups. So the focus is on startups which are actually innovative and which are also scalable. So here, the venture capital investors, for the kind of equity investment they make, they take equity and in exchange for capital and strategic guidance. So venture capital, why it is so important for enterprises? First is it provides a high risk capital that banks don't offer. So any startup there is definitely a huge risk. The huge risk is there. So venture capital provides that capital, high risk capital that banks do not offer, and they accelerate the innovation. This actually capital accelerates the innovation, technology development, because any organization today, technology development is the backbone, and market expansion. And venture capital is also they help the entrepreneurs to overcome the resource constraints, and this in turn drives the job creation and economic growth in emerging sectors, because today startups are actually one of the major sources of employment generation, because the startups usually they want to grow, and that is where they actually hire more manpower. So these are some of the reasons why venture capital is important for enterprises. Now, one of the key features of venture capital financing, it's an equity investment and it's not a loan. And here the returns is high risk, high return venture capital financing. And the investors are very, very active involved, unlike like a debt financing by a bank. And the investment is also a pretty long period, 5 to 10 years. So this is some of the key features and the stages of venture capital financing. Here we have the seed stage, then we have the startup stage, then we have the early growth stage, and then expansion stage and late stage, pre-IPO stage. So in the seed stage, where what happens is the funding goes for idea validation and prototype development. Whereas in the next stage of the startup stage, once your idea is validated and prototype is developed, and you go for the development of the product, and then initial marketing is also done. And then the early growth stage where you scale up the operations, and the expansion stage, you go for expansion of the market, you do acquisitions. And the last stage is the late stage where preparing for the public listing or the buyout. Now, how does the VC do this funding process? They start with the deal sourcing and screening, and then the VC firms do the evaluation of the business model of the enterprise and the potential of the market where the particular business is operating, and they do the due diligence, financial, legal, and technology. And they have something called the term sheet negotiation, where they actually capture all the data before they do for the negotiation part. And then once it is done, the agreement is done and the equity allocation is done, and they keep on continuously monitoring and then keep on doing value addition. And then always this exit options always they may look at very seriously for acquisition and buybacks. So what are the criteria where a VC invests in a firm is? First of all, they look for a very strong team and they look for a very large market. And also the business model has to be very innovative. And they also see if there is an IP competitive advantage and there is a high growth potential. And there is a clarity in the revenue model, and exit potential and valuation prospects is also key. And these are some of the documents required by VC investors: the pitch deck, the detailed business plan, market research insights, financial projections. The last 5 to 7 years is very important. Capital table, the profiles of the founders, and then the POC or the prototype, and the legal documents. And this is some of the role of the VCs in enterprise growth. So they provide very clearly the capital for research and development, marketing, and expansion, and then access to networks, support and talent acquisition, enhance credibility for future funding rounds. So advantages of venture capitals. Since it is equipped with, there is no repayment burden, which is a huge advantage for organizations. And they give open market global connections, and they help attract top talent because of the venture capital brand is involved in the organization. And some of the limitations and challenges, definitely there is a loss of ownership and control because it's an equity investment, and there is always high expectations from the investors that the business has to grow fast, and revenue generation, profit, everything. There is a huge expectations from the investors, and there is there's a possibility of conflicts between the founders and the investors, and pressure for rapid scaling and deeper reporting and compliance with these some of the levels. So this is some of the comparison with venture capitalists with other financing firms. You can clearly see in terms of the venture capital term loans, angel, and what are the returns, risk control, and these four areas we have seen, can have a clear picture of the comparisons. And as I already told you, we have these following types of venture capital: seed, early stage, growth stage, corporate, impact, and sector specific. And this is a case study of venture capital, which we can discuss later. Then government policies for supporting VC funding is we have the Startup India Seed Fund Scheme, SIDBI scheme, and alternate investment fund regulations by SEBI, and incubators and accelerators by Niti Aayog, and tax incentives under 81AC. So these are some of the emerging trends in venture capital: deep tech and AI funding, growth of corporate venture capital firms, Tata, Reliance, Google, and Microsoft, venture capitalists for early stage startups, and ESG is very important. The environmental, social, and governance norms, and global investor is also entering the Indian market. So these are some of the best practices for a startup VC funding, which you've already seen, and this is a summary overall. So VC is a very critical for financing of an enterprise. They offer mentorship, funding, and networks and global opportunities, and these are very effective for organizations with high growth and risk appetite. So thank you very much.